So I just can't seem to escape these cows. The other day I did a video on an ETF called Cows, who, it was a great ETF. Obviously, the name Cows kind of sticks out. Unforgettable name there. And they were kind of, they weren't really a high dividend per se. They were, I'll say, a high dividend grower because they invest in the cash cows, essentially, the people with the high free cash flow. And those are the companies that typically have room to grow their dividend. So the idea is they're trying to really get the companies that can afford their dividend and grow their dividend. And I thought it was a great strategy, minus a few of the holdings, which were very questionable. But yeah, I did make that video the other day, which I will pin to this, by the way. But anyway, the point of that story is, like, the first few comments is, what about HCOW? I'm like, what the hell is HCOW? And sure enough, there's an HCOW. And obviously, HCOW more so fits my latest agenda, being high yielders. So today's video, I will cover HCOW. And before I get started, as always, not financial advice. I am not a financial advisor, nor do I want to be one. But, I'm just making videos for fun, and hopefully you guys enjoy it. So, long story short, HCOW, they essentially invest in cows, and they do covered calls. So, let's get into that. So their actual name, Amplify Cash Flow High Income ETF. Okay. When did they launch? September 20th, 23, this year, not that long ago. Net assets 2.9 million. Again, pretty new. Total holdings 2. We'll get into that. Expense ratio 0.65%. Again, this is an options ETF, so that's okay. That's a good expense ratio. Fund documents, we'll get into those too. Okay, 3 reasons to own HCOW. High current income from dividends and S&P 500 based call income strategy. So basically, if you're not, you're getting dividend income from the cows ETF stocks, and they're selling calls on the S&P 500. Pretty damn cool. High free cash flow stock exposure. Yeah, so they kind of went through that. This kind of speaks to cows, companies with payout ratios less than 75%. Strategy seeks 80% or more exposure, high quality U.S. based dividend paying stocks within industry exposure of 24%. Again, kind of just saying what cows states. If you understand cows, HCOW's very easy to understand. Actively managed. Okay, that's why they get 0.65%. No yield yet. They pay monthly. Good. NAV is 24.17. Closing price 24.14. Pretty close. How's the chart? Okay, not bad. And here's some of the holdings, which again I'll get into. But again, I like to pull up the holdings via the link. Selection methodology. I mean, this is kind of going to be covered in the. I'm going to go through the prospectus. Distribution schedule. They're going to pay the end of the month for those of you that care about payment dates. Yeah, and that's it. So again, we'll go through the links in a second. I did my usual, and I saved the prospectus, and I highlighted what I believe is important. So let's just go through that real quick. The prospectus is dated September 18th, 23. Again, 0.65%. They're not waiving that. Actually, if you remember, I'm pretty sure it was cows. They waived their fee, at least for the first year. And now that I'm thinking about it, that's a good thing, because HCOW is going to own cows ETF, I believe. So we don't need to get double dipped on. So the fact that they're waiving that, well, let's keep an eye on that now. The fund invests 80% net assets, blah, blah, blah. Okay, so 80% of it goes to COW's ETF. So if COW's ETF charges an expense ratio, you're going to be paying that on those, on that part of it, on 80% of your portfolio. So I don't know, again, I believe it's exempt for the first year. So that's something to keep an eye on. I just thought of COW ETF. I'm not going to be too repetitive here, but COW invests in basically companies that are on the Kelly Index, which pretty much, again, heavy cash flow companies that can afford their dividend and more. Now, this is what I saw on the COW's perspective, which I highlighted then and I'm highlighting now. Companies must have at least 3 million average daily volume. As you know, volume drives, the implied volatility, which drives the options premium amount that you can get. So the fact that they're striving for, I don't know if we would consider this higher volume, but they have a required minimum, which is good. That means that the premium paid out on selling, actually no, because they sell calls on the S&P index. So that really doesn't matter, honestly. So I apologize. I was thinking about that yesterday. Yeah, because this fund buys cows. They buy cows and they sell calls on the S&P index. And they use the cows' holdings as collateral, which I'll probably cover again here. So here it says they'll be selling, calls each day, 2 call option contracts on the S&P 500 index with targeted expiration dates of approximately 2 weeks into the future. Okay. But they're selling 2 call options contracts, both expiring the same date. I don't know. Maybe not. Call income strategy targets strike prices that produce a 10% annualized gross income. That tells me that from the premium income alone, they want to make 10%. So the yield on this, I'm just thinking, again, 10% plus. 10% from the premium, and then an additional, let's just say 4 to 5% on cows, which, again, you're going to own cows, so you're going to get the dividend from that part. But 15%, I mean, that sucks, but still, I mean, we're in the days now where we're saying 15% sucks, but I don't know. It depends. I still, so far so good. I like this fund, but that's what I'm getting at so far and what to expect. Maybe 10% is just the minimum. Maybe they'll get 20% and they'll have a 25% yield, but time will tell. The fund will hold certain assets that serve as collateral allocated to the call income strategy. So yeah, as mentioned, they're going to sell calls on the S&P index. I believe it's SPX, and then the collateral against that will be the COW's holdings. In the event the S&P 500 index declines in value, the call option may end up worthless, and the fund retains the premium. So, as you know, selling calls are bearish. So if the S&P 500 declines, that's a good thing, and the call expires worthless, which is what you want, and then you just keep the premium. I kind of like how they explain this because a lot of people don't understand options, so it's good to explain it to your shareholders. Now let's look at the other part of it. The reverse that can happen. In the event S&P 500 index appreciates above the strike price as of the expiration date of the option, the fund of the call option will have to pay the difference. So if let's say the SPX is $300. If they sell a call that's $305 and it expires at $310, they'll have to pay the $5 difference. Okay, how do they pay it? They pay it through a reduction in the fund investment in the COW's ETF. So they're going to sell your COW's funds in order to support that, which, I guess we can call that some NAV erosion, right? They'll sell some of the value of the fund. So, because again, that's the collateral. They got to get it from somewhere. I don't know if they'll get it all from there or some from the options premium they already made. But again, time will tell. Let's see. The fund intends to implement a call income strategy by entering into one or more swap agreements with a financial institution for a specified period, which is expected to be at least 13 months. Okay, let me just say, I didn't really understand swap agreements before this, and I vaguely understand it now. But I highlighted this in pink because, again, I would recommend, if you really want to understand swap agreements, you're not going to get it from this video. You should probably, just YouTube another video if you really care that much. I'll read this, but again, long story short, it's an agreement with someone else to get something in return, and you have to provide something in return. So essentially, they're going to ask, they're going to try to guarantee a certain percentage of income in return for giving them, maybe a percentage, a percentage back. So let's just read this real quick. I don't want to bore you guys too much, but so the swap agreements will seek to exchange the target call income, which is the rate of which the expected to fluctuate, provided by the call income strategy's daily sold call options for a set percent of call premium over each call period. So again, we're trying to get a set percent for each call period. Through each swap agreement, the fund and the financial institution will agree to exchange the return earned or realized on the sold call options. The amount to be exchanged or swapped between the parties is calculated based on a notional amount, which is the return on or the change in value of a particular dollar amount representing the sold call options. In addition to the swap agreements, the fund may also directly sell call options to execute the call income strategy. Okay, anyway, I'm done talking about swap agreements, but they're basically trying to cover their asses. Just think of it as like insurance. This fund is classified as non-diversified, just like COWS, which I don't agree with that statement because COWS is diversified in my opinion. There's a swap agreement risk definition. The fund expects to use swap agreements as a means to achieve its investment objective. Again, they want to achieve their investment objective, so this is another security blanket in order to do so. 28 pages of prospectus, and I think that was the last. Oh no, yeah. So there's more swap agreement info. I'm not going to read any more on swap agreements, but I will save this file for you on my Discord under the files channel, which has all of the highlighted important factors. But yeah, it's a good thing. Could limit their, high income potential, but secure their low income, minimum. Okay, sorry for scrolling too much, but that's it on the prospectus. Now let's go back to the website and just see what we missed before. As always, I like the fact sheet. Just quick and easy. Again, monthly payer, launched September 20th, expense ratio 0.65%. Okay, good. All of this is kind of covered, and as you can see, the COWS ETF sector allocation looks diversified to me. Energy is the high one. Next, number 2 is consumer discretionary. COWS ETF top holdings, we covered that in the other COWS video. I'm not going to really get into that. But again, if you own HCOW, you pretty much just own COWS. Okay. Free cash flow explained. I'm not going to get into that because I got into that on the COWS video. All right, let's go to the holdings. Download, view. I mean, let me just say the format of this website is horrible. I mean, look at this. I got to scroll over here to look at freaking holdings. Okay, so what in the hell are we looking at? Amplify ETF cash flow dividend. Okay, so the top one I would say represents the HCOW's ETF. So obviously the majority, they said 80%, it looks like 89%, is holding HCOWs. So if you invest in HCOW, they buy their own ETF called HCOWs. So if you like cows, then HCOW's for you. If you don't like cows, then you want to avoid this fund. Here's the swap agreement. It shows as a holding. So I guess, the contract expires, looks like September 24th of 2024. Should probably, see how that changes over time. Could probably make another swap agreement video just to make sense of it, but I don't know how much impact it's going to have. Again, I'm assuming it's just the type of insurance which will guarantee us a specific amount of income, but limit the upside, I'm sure. Cash is cash. So, but as you can see, what's missing is the covered call, the SPX covered call. This fund is very new, so maybe they didn't do one, or maybe one expired on Friday and they didn't do another one, or they didn't roll it over. So that's, I can't really see that, but you would see it as an SPX. If you look here, don't see it, right? I think they had some holding info up here too, right? Number of holdings. Yeah, nothing there. But yeah, that's it. So that's HCOW in a nutshell. It's, again, a high income ETF. High income. They get income from premium from the S&P 500 calls. So they strive for 10%, which seems like it's going to be guaranteed under the swap agreement. Hopefully, we'll see. And then they don't own the S&P 500 index, so they buy HCOW. They buy COW's ETF with all of your money, most of your money, 80% plus, and they use that as collateral in order to sell the calls on SPX, or S&P 500 index. Now, COWs, all of those funds pay a dividend, possibly 4 to 5%. So if they strive for 10% premium income, 4 to 5% dividend income, that's 15%. So again, typically not tax advice, but 10%, if that's premium, that's unqualified dividends. The other 5% could be qualified if held for a certain period of time. So that's a good thing. However, I would like 20%, 25% or more from this fund. If they do pay that, I'm in. I'm definitely in. If they pay 20%, 15%, I just got to think about it. I did honestly like cows, and I was going to buy into it later, but now I can own cows while still making a higher yield. So this is really, this was kind of made for us, right? Us as the high income investors. But so, I mean, in summary, I like it. I really do. Obviously, here's some tax information. I didn't click call income data. Let's just see if that's useful. Oh, never mind. Here we go. Sorry about that, guys. Here is the SPX calls. Expiration date, October 20th. What the hell's today? Yeah, so Friday's the 20th. All right, so they have calls on the SPX expiring on the 20th. All right. Good. Why? First of all, why is this separate? Why is it not with the holdings? I mean, this is annoying, but regardless. All right, so here's their calls. Obviously, you could see this is just the holdings. You can't really see how much they made per the trade. I didn't see anything on the website about the the actual intraday trades, but this is a lot to cover. Sometimes this is why we pay them, right? But yeah, and they have tax information, which is cool if you care about that so much. But yeah, that's it. And here's the link to the cows ETF. Looks like a quick link. Never mind. That's Devo. I don't want that. Really? All right, they better fix their website. Yeah, so that's it for today, guys. That's HCOW in a nutshell. I do like HCOW, and I will not buy into it until their first distribution, and we will see what that comes to be. Maybe I'll make a follow-up video at that point in time. But for now, I'm gonna wait. But like I said, I do like it. I like it a lot. It's pretty good idea. Let me know what you guys think of this video via like, comment, etc. And that's it. Have a great day. I'll talk to you soon.